All right, so we've got our W-2 at the end of the year. That's the form that we're going to use to report our taxes on tax return, right? Mm-hmm. So let's say, well, first off, what's the deadline to file your taxes?
Typically, it's April 15th. So the calendar year is also the tax year. It can be different, but for most people, it's going to be January 1st to December 31st. And then you get 3.5 months after the end of the tax year to file. So that's April 15th.
That's a decent amount of time for most people, I think, to get their taxes
And it's
done.
important to note that if April 15th falls on a weekend or a holiday, it's the next business day afterward.
Okay. And so what are my options for filing taxes at the end of the year?
Yeah. So, I mean, most people probably go online to a software, TurboTax, H&R Block, do it themselves. That's probably your most common, especially if you have a simple situation. But as complexity increases, if you have multiple accounts, multiple streams of income, you might go with a preparer, a professional preparer, a CPA, enrolled agent, someone to prepare your taxes for you. And my favorite is preparing by hand at the end of the year. Probably don't want to do that because you might make mistakes, but it does keep you sharp.
We have multiple options, right? Maybe the tax software is going to be simple and easy and your life's not too complicated. But as things get more complex, maybe you have the W-2 income, you have a side hustle, right? Mowing lawns. Maybe you are an influencer, right? Maybe you are selling things on eBay, right? So there's so many options for that side hustle that can make the tax picture a little more complicated because you want to make sure you get all the deductions and all the credits and things that you're eligible for, right? And then finally, even with your very first job out of college, I've seen some young professionals who have stock options, right? And that's a whole nother. We could talk about that in a separate episode, but that also adds complexity to the tax situation.
Yeah, absolutely.
So just take a moment to kind of gauge your situation. And if you feel uncomfortable about certain things and you're not 100% sure that that tax software is asking you the right questions or taking advantage of everything, that might be a sign that you might want to consult with a professional, right? Assuming, all right, we're going to do this. We're doing this by hand, but we're going to show you an example of a paper tax return so you can see the different components. But this is very much what a tax software or CPA would ask you.
And I'll add that regardless of how you do your taxes, if it's by hand, if you prepare it on a software, or if you use a preparer, it should look the same. If you have the same documents, most things on there should be exactly the same.
All right, so let's pull up a tax return here for John Doe. We're going to walk through this page by page. So this is the first page. A lot of it looks like mostly we're just getting the personal information on the tax return. But Matthew, anything else that stands out that should be noticing here?
Yeah, your filing status. If you're young, just starting out, you're probably single. Maybe you're married. Maybe you have a child and filing head of household. But typically, you're going to be single, especially in your younger years. But as you get older and maybe have kids, then the dependent section is important. So if you have children, you can claim them as dependents if they meet certain rules. Another one, digital assets nowadays is very common. So if you are investing in crypto or anything of that sort, you have to disclose that on your return as well.
What happens if you don't disclose those kind of things on your tax return?
I'm not entirely sure with the crypto side of it, but you should be honest, and if you have it, you should indicate as such.
Yeah, I mean you can be penalized and there can be interest, and I have seen the IRS come back and ask about something from 3-4 years ago. So just be mindful of that, right? It's better to be honest and just report what's going on so that you don't have issues down the road. And because there might be credits and deductions that you can take advantage of to maybe soften the blow if you did is maybe just had you just sold some crypto, for example, for a gain.
Do the right thing
Do the right
up
thing.
front.
Dare to be honest. All right, so let's go down the tax return some more. This is the basic information on the first page. Now here we are on the second part discussing income or reporting income. All right, so I see we got 48,500 at the top. Where's that number coming from?
So that's
Again,
coming directly from the W-2.
it's coming from the W-2. Okay. So that's the income John Doe earned from that job for the entire year. What else will we be reporting here?
This could be any income you receive is going to fall in this first section. Different types of income, but for John's sake, maybe he has a bank account that earns interest, a high yield savings account that earns interest. So I entered in $150 for his taxable interest for the year. So his wages plus his interest would give us that total income amount.
Got it. Yeah, and I think that's a very simple setup, but it's also very common. I see a lot of folks who are, they got their job, they have a savings account, maybe some investments on the side, but these are the most common things that you're going to be reporting on your tax return. All right, so now we're moving on to tax and credits. It looks like the 48,650. So we're starting with that total income number, or it says adjusted gross income. Tell us a bit more about that and like kind of what we're seeing here.
Yeah, so you add up all of your income, and that'll get you your total income. And then there's a special item called adjusted gross income. And I like to think of it as kind of your halftime score. So things that phase in, credits, deductions that phase in, that phase out, are typically based on adjusted gross income or modified adjusted gross income. If you have student loan interest and you make above a certain threshold of AGI, it will get phased out and you're not able to deduct that. So AGI is kind of your halftime score is how I like to think of it. But after that, after you total up all of your income and you take away either a standard or an itemized deduction. So you're allowed to take your taxable income, which in this case is $48,650. And since John is a single taxpayer, he can claim a standard deduction of about $15,750. So every taxpayer either gets the standard deduction or the itemized deduction. Typically, you'll want to take the higher of the two. But after you deduct the standard deduction, in this case, that arrives at your taxable income. So we'll touch on this a little bit later, but your taxable income is what is the amount that's used to calculate your tax. So from there, based on his rates and his brackets, which again we'll touch on in a moment, the tax is calculated. So you can see on line 24, it's about $3,700 of tax. And then if we jump down to the next section, from the W-2, the amount of federal income taxes that he paid in was about $3,782. So we net the total tax that's calculated on the return versus what he withheld throughout the year on his W-2.
I see.
And depending on those two numbers, if you make estimated payments or withholding on your wages, there's lots of ways to pay in money or taxes to the government. But we net that against your total tax. And depending on that number, you could be due a refund or have to pay additional taxes.
You can see how this math can can start to feel a little bit maybe confusing, or not necessarily confusing. Like there's just a lot of layers to it, right? But at the end of the day, based on what you withheld from your job in federal and state taxes, the IRS is going to calculate what you should have paid, and then you report what you did pay, and we net the difference together, and you're either going to get a refund saying, oh, hey, I accidentally withheld too much, or you may owe a little bit to make up the difference if you didn't withhold enough. Okay, so it looks like at the end of the day, John Doe ended up paying $3,782 in taxes. He owed $3,713. So he ended up getting a refund of $69.
So he only needed to pay 3,713, but he paid more, so that's why he got a refund.
Got it, guys. So he needed to pay $3,713. Not necessarily owed. That's how much he needed to pay, and he withheld $3,782.
At a bare bones level, this summary 1040 page is your income, your deductions, and then your credits.
Got it.
And then after that's all computed, it's your tax and your payments to the government.
Got it. And so this number, this total tax number, this 3713, that was calculated from his taxable income of 32,900. Yes. Right? So we wanted to show an example of the tax brackets and how your income is actually taxed. So I think there's some myths there about, well, what percentage of my income goes towards taxes? Can you talk a little bit more about that? Like how is our tax system set up?
Yeah, so the federal tax system is a progressive rate system. And what that means is that not every dollar of taxable income is taxed at the same rate. So I want you to think of it as buckets. So the first bucket is taxed at 10%. And then any additional dollars past that bucket goes into the next bucket. And that's taxed at 12%. And then anything past that is in another bucket, taxed at 22, 24, and then you just keep going down as you continue to earn more income. And a common myth that people think is that, oh, I don't want to earn more money because then all of my money's going to go into that next bracket, which isn't the case because as we know, it's a bucket, bucket, bucket. Each is taxed at a separate rate. And for state income taxes like North Carolina, sometimes they're a flat rate. So it could be a progressive rate, it could be a flat rate. It depends on your state. But for federal income taxes, it's a progressive rate structure where each bucket of income is taxed at a different rate. So that makes it a little bit more advantageous to do planning opportunities if someone is in a certain marginal bracket, is what we call it. But not every dollar is taxed at that rate.
That makes sense. So the more, when we talked about our pay stub example earlier, we said, the more of your money that you put towards benefits like retirement accounts, health insurance, health savings, that actually lowers how much of your income is going to be subject to these tax brackets. Exactly. Right? So take advantage of those opportunities. And also recognize that not that entire bucket of money is going to be subject to tax because you're going to pay yourself with some of that money in the form of those benefits that we talked about. Okay. All right. So I think this is a good high level summary of a tax return. So we'll kind of jump out of this. And I think let's talk a little bit more about, what are some things we want to walk away with today? Like, if you could talk to your younger self, or even your younger self, like, what are you, 20, 25 or something? 24. You could talk to yourself now. But no, seriously, what is something you think our listeners should walk away with today?
Yeah, I think it's just important to know where your money is, what's being taken out, what is it used for, a basic understanding of why these things are happening, how it flows. You don't have to have a PhD in this stuff, but it's important to know for taxes, for anything financial related, in my opinion, that just kind of have a basic understanding of, why am I investing in this? Why are these taxes being taken out? What is the purpose of this? Yeah. A bare bones level, 30,000 foot view of it is all that you need, but it helps you down the line and understand where everything is going, why it's going there, and hopefully helping your future self out, your current and your future self.
A common misconception is that paying taxes is bad. I want to avoid taxes I want to avoid every single tax possible and pay nothing. Because the fact is that those taxes are important to help our society function the way it should. so that we can be safe, so that we can have, roads that don't have a bunch of potholes in them, right? So there is a level of taxes that supports everybody. And sometimes paying taxes can just be a product of being successful. If you get that promotion, you get those stock options, your income shoots up, you win the lottery, right? It's all any of those things can happen. And sometimes paying more taxes just says, hey, like, you succeeded more this year, their taxes a little bit higher, but also your opportunities to reduce your taxes, to save on your taxes, that also starts to open up more as your income goes up. So yeah, think about it from both sides and just see taxes as more neutral, as difficult as that might be sometimes.
They're a part of life, and you have to pay them. But like you said, as your situation becomes more complex, your opportunities increase, and the things that you can do to, be more efficient in your
Yep.
taxes. I think that's a good way to think of it, is being efficient versus avoiding taxes. Because
Efficient. Yes.
yeah, because you can't avoid them. You're going to have to pay a certain amount, but we don't want to have to pay more than what we should.
No, well said. I think, well, thank you so much, everyone, for listening today. If you have any questions, you can head to our website, financialsymmetry.com, or if you got more blog posts and videos around the topic of taxes. And just remember, right, if you're feeling uncertain or like you want a second set of eyes on something, it doesn't hurt to speak to a tax professional, whether it's a financial advisor, even going down to your local, tax preparer, and just having someone with an experience double check things and maybe catch things that the softwares don't always catch. So once again, thanks so much for tuning in, and we'll catch you next time on an episode of What I Wish I Knew About Money as a Teenager.